Welcome to the Inner Game podcast, where we embark on a journey through the realms of money, investing, life, and philosophy, one profound idea at a time. I'm your host, Vishal Khandelwal, and today we are going to explore a concept that's crucial for anyone interested in investing. It's the idea that investing is not just a game of numbers and analysis, but it's deeply intertwined with human psychology and social behavior. This insight reveals that investing is much more than a solitary number crunching exercise. In fact, it is a fundamentally social exercise. Let's start with something we are all witnessed: the influence of stock prices on our actions as investors. Now, stock prices are not just barometers of a company's performance over a long term, they can actively shape our investment decisions. And this brings us to the fascinating, sometimes dangerous world of stock market bubbles. History is filled with such examples where soaring stock prices have led to irrational exuberance, leading to widespread envy and herd mentality among people, and ultimately followed by dramatic crashes. For example, let's travel back to the 17th century with the Dutch tulip mania. This was possibly the first recorded speculative bubble. Tulips, yes, the flowers, they became so coveted that their prices reached astronomical heights. People from all walks of life, they were seduced by the tales of immense wealth being made in tulips. They poured their fortunes into tulip bulbs. But like all bubbles, it burst, leaving many financial ruined. Then take the South Sea bubble of the early 18th century. It's a classic story of how the South Sea Company's stock became the center of a speculative frenzy in Great Britain. The company's promise of vast wealth from trade in the South Seas led to an astronomical rise in its stock price. Investors from all walks of life jumped in only to face a catastrophic collapse that ruined many of them. And in case you don't know yet, one of the most striking stories from the South Sea bubble was that of one of the greatest minds in history, and that was Sir Isaac Newton. Newton, who's known for his groundbreaking contribution to science, also dabbled in the stock market. And during the South Sea bubble, he initially invested in the company, made a good profit, and wisely exited early. But here's where things get interesting. As he saw the stock continuing to soar and his friends making a lot of money, even a mind as brilliant as Newton's fell prey to the social pressure and greed. He re entered the South Sea stock at a much higher price, only to see the bubble burst soon and leading to significant financial losses to himself and also the loss of his reputation as an investor. This tale of Newton's misadventure in the stock market is a perfect example of how even the brightest and the best minds can get swept up in the euphoria of rising stock prices. It shows how powerful the social aspect of investing can be that overrides logic and reason at a lot of times. Fast forward to the 20th century, and we have the infamous dot com bubble of the late 1990s. It's a classic case of irrational exuberance where the stock prices of internet companies reach stratospheric levels. The idea was that traditional business metrics did not apply to these new tech companies. But when reality hit, it hit hard, and it led to massive market correction and massive losses to a lot of investors and speculators out there. Now, the question is, how do wise investors avoid getting sucked into these whirlpools of influence? I think it's entirely about developing a mindset that's immune to the crowd's opinions and fears. The wise investors steer clear of such frenzies because they are the ones who can block out the noise, the hype, and the fear of missing out. But this is easier said than done. And why? Because as humans, we are wired to care about what others think of us. We are wired to want to belong to the group. We do as others do, without often thinking it others are doing the right things. And at a lot of times that gets us into a big trouble. Think about Warren Buffett, one of the greatest investors of our time. He is known for his investing strategy that often involves going against popular opinion and market trends. Now, Buffett's success is largely attributed to his ability to detach himself from prevailing market sentiments and focus on the intrinsic value of his investments. And not just Buffett, there are many other such investors, both outside India and within India, who have benefited from such detachment from what the stock prices and markets have been doing and focused on what businesses have been doing and what they wanted to do and how they wanted to benefit from the market's panics and manias while ignoring all the noise all around. So, what's my perspective on all of this? I believe that the true art of investing lies in understanding the delicate interplay between market trends and human psychology. It's about learning from history, recognizing the patterns, and having the courage to trust your own analysis, even when it goes against the tide. Basically, you can do these five important things to avoid being unduly influenced by stock prices. The first thing you can do is to educate yourself. Knowledge is your best defense. Understanding the fundamentals of investing, learning about market cycles, and educating yourself about the historical patterns of bubbles and crashes is very important. The second thing you can do is to develop a long term perspective. Focus on long term investment goals rather than short term market trends. This helps in making more rational decisions, less influenced by markets' ups and downs. Thirdly, create a diversified portfolio. Now, diversification can help shield you from the volatility of specific sectors or stocks or investments in general. It's about not putting all your eggs in one basket. The fourth thing you can do is to practice emotional discipline. Train yourself to maintain composure during market highs and lows. Practice the idea of equanimity and avoid making impulsive decisions just based on fear or greed or even envy. And finally, have a sound investment strategy. Stick to a well thought out investment plan. This should be based on thorough research and a clear understanding of your own financial goals and risk tolerance. I must repeat here that investing is not just about making money, it's about making smart, well informed decisions that align with your own goals and values. If you are blindly influenced by someone else or by stock prices, you will only end up in a big problem later. So, what do you think? Have you ever encountered a situation where you had to choose between following the crowd or trusting your gut? Please share your experiences in the comments. And if you are new here, please don't forget to subscribe for more deep dives into investing, history, and the human psyche. Until next time, happy investing and remember to stay true to your path, no matter how unconventional it may seem. Thank you.